Taming the High Cost of College, Episode 10.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Hello, and welcome to Episode 10 of Taming the High Cost of College. I'm your host, Brad Baldridge. Today, it's a very cold but sunny day here in Wisconsin, and now that we're into January, it's time to start talking about the FAFSA. If you have a senior, you should be working on the FAFSA now, here in January. Perhaps you can delay it till February, but sometime soon, if you have a senior, you should be working on the FAFSA. If you have a junior, you need to start thinking about the FAFSA, because then you're only a year away, and you may want to do your prepping and planning. If you have a sophomore or less, I'm glad you're listening, and it certainly is not too early to start learning how financial aid works. So today I have two segments. The first segment is 5 quick tips focused on if you have a senior right now where the year is gone. 2013 is the year for the senior. It's currently January of 2014. So we can't go back and change what we did in 2013, but there may be a few things we can do before we fill out our FAFSA. The next section I have is the 10 common financial aid mistakes that I see out there and what to do about them. So again, we're going to focus a whole lot about FAFSA and financial aid, and let's go ahead and get started with that. All right, so 5 last-minute tips for filling out your financial aid forms, or your FAFSA. So the number one tip I always tell parents is you need to complete the financial aid forms on time, both the FAFSA, and if you need to do the CSS profile, which we've talked about in the past, then you certainly need to get both of them done on time for your particular school. So what does on time actually mean? Most schools have a deadline published on their website and other places that is kind of their preferred deadline. Say February 1st, February 15th for some of the private schools or the earlier deadlines. And other schools may wait till as late as, say, April 1st. Whatever schools you're dealing with, you need to be on time and perhaps a little bit early. So if you're intending to apply to high-end schools, especially, a typical deadline of February 1st makes things very tight. One of the biggest challenges for most families is having your taxes available so that you can fill out the FAFSA properly, because they take quite a bit of data from your taxes in order to fill out your financial aid forms. Now, most families are not going to be able to get their taxes complete because they're not going to have all the forms and data necessary to actually do your taxes. So the tip here is use estimates if you need to. You much rather be on time or a bit early and have relatively close estimates versus being late but having the exact numbers. So how do you get estimates? Well, for many families, it's pretty simple because last year and this year and next year are all going to be about the same because you earn a salary. Life hasn't changed that much year to year. So then a quick solution might be to just use last year's taxes. Last year's taxes might be close enough. And if you're going to err, and often it works out this way, but you want to be a little bit low versus a little bit high because it's a lot easier for them to correct and take something away versus correct and then try and offer you something new where that new money may be already gone. So you want to come in a little bit low. When I say a little bit low, let's say your income is $100,000. If you come in at $96,000 or $97,000, that's a little bit low. If you think your income's around $100,000 and you come in at $50,000, that's a bit ridiculous, and they're going to essentially redo the entire process if you change your numbers that drastically. All right, so you want to be on time. You're going to need to have your taxes done. What if you're in a situation where year over year your taxes change? Let's say you're either paid on some form of commission, or you own a business, or you get salary and bonus, and the bonus changes every year. There's lots of reasons, or you've changed jobs, or whatever it might be. There's lots of reasons why your income may be in fluctuation where last year's taxes may not be a good estimate for this year. Now, when I'm helping families with this, the easiest way to work it out is to take last year's taxes, take a red or green felt tip pen, and just start marking it up and correcting all of the numbers as best as we can. So typically at the top of the form, you've got box 7, I think it is. It's income from your various wage-paying jobs. And if you know typically what that's going to be because you have your salary information on your last pay stub. Now, granted, for many families, the amount that you actually put on your taxes is a lot less than your salary because some of that money is going into 401ks, some of the money goes to healthcare, some of the money goes to daycare. So there's lots of reasons why your actual taxable income would be substantially less than your salary. So a good thing to do there is to look at last year's taxes, last year's W-2, and last year's ending pay stub, and then look at this year's ending pay stub and try and make some reasonable guesses as to what the W-2 is going to say if and when you get it. So a typical family, let's say, again, your salary is $100,000. Last year, you had $12,000 in deductions. So actually on your W-2, it said $88,000 because you had $12,000 of deductions. This year, your total take-home pay was $102,000. You're probably going to have similar deductions. So you can say, well, this year I'll put in $90,000 because I think that's a good estimate. So then as you move down the form, you go kind of down the lines and look at all the various forms of income that you had last year and put in new estimates. So if you had unemployment on a line and you didn't, that needs to go away, you can delete it. If your business income from your Schedule C or from your Chapter S corporations lands at a certain place and that's going to be different, then change it. You kind of rework the form all the way down as far as various income blanks, and then you move on to the deductions and all those sorts of things. So that'll help you figure out what your AGI is, and if you move to the second page, you can get a current tax table and calculate what you estimate your tax to be. And again, you do the best you can. If you have a real complex situation, there's a good chance you're working with an accountant who can help you through it. But again, your goal is just try to be close and perhaps just a little bit under where it may actually come in. So that's tip number 1 is get your financial aid forms filed on time and use estimates where you have to make it happen. Tip number 2, last minute asset strategies. As we talked about in a previous episode, episode 2, there's 5 major things that impact how much need-based aid you're going to qualify for. And those 5 things again are income and assets of mom and dad, income and assets of the student, and then finally the number of students that you have. Well, the income at this point, if you have a senior and we're in January now, the year is over. You can't have a lot of impact potentially on what your taxes are going to look like. But you still potentially have time to adjust the assets. What does that mean? Well, let's say you have $50,000 in the bank and you're going to have to report that as an asset, and that may cause reduce your need-based aid. So if you want to report less than 50, perhaps you can spend some of that. Well, how would we spend it? Well, you could pay down debts. If you have a $20,000 credit card bill and $50,000 in the bank, you're going to have to report the asset, but you do not report the debt. So you may be better off to take your money out of the bank, pay off your credit card, and now you have a $30,000 in assets instead. So you can pay down debts. You can also pay bills in advance. So pay your property taxes, pay your insurance premiums, pay for a vacation, pay for the remodeling that's going on at your home, but pay the bills that you know are coming and get that out of your account as well. You also might be able to contribute to retirement plans. Submit money to your Roth IRA or to your traditional IRA are the big ones, but you also might be able to make contributions to other non-reported accounts and take care of it that way. And then take care of the money that's in the student's name. We mentioned assets in the student name is actually assessed higher than assets in the parent's name. So it may make sense for little Johnny and little Susie to spend their money. If they were going to buy a laptop for college, now might be the time. Or perhaps they need to reimburse mom and dad for some of their expenses that they've paid over the last couple of years. Find ways to use up the money that is in fact in the student's name. Now, if the students have a lot of money in their name and we're kind of at the 11th hour and you don't have a good place to go with it, you can also put that into a student-owned 529. Now, the advantage of a 529 plan is primarily taxes, but when it comes to financial aid, all 529s are reported as a parent asset. So if your student has $20,000, let's say grandma and grandpa was generous at some point and put some assets in the kid's name, you could then take those assets and invest it in a 529. The student still owns it, and technically it's still the student's money, but for financial aid purposes, all 529s become a parent asset. So that would be the last minute asset strategies. And the next idea is that there's 3 blanks on the financial aid form that need to be filled out for the parent and the student. And they're pretty vague and generic. So I want to give you a quick tips on that as well. There's a question that asks, they're all about your assets. So they put it in 3 main categories. They say, what do you have in the bank? What do you have in investments? And what are your businesses worth? So those are the 3 categories that all your assets have to fall into. And you also have to realize that some things are not going to be reported. Again, if you go back to episode 2, there's a long discussion about what assets are included and what assets are not. So you can go back there and get more information. But in general, the bank accounts would be pretty obvious. What do you have in checking and savings and money markets and that kind of stuff at the bank? For investments, that's what do you have invested, but it does not include investments that are inside retirement, as an example. So it does not include your 401ks, your IRAs, does not include your annuities, does not include a life insurance. It does include things like stocks and bonds and mutual funds that you own outside of your 401ks. And it also includes assets that you may hold in a trust that aren't otherwise also in some sort of retirement plan. And then the last asset question is, what is the value of your business? Now, many small businesses are not included here. Again, if you have less than 100 employees and the family owns more than 50% of the business, oftentimes that business is excluded as well. So if you may need to delve into the rules a little bit on that subject if you have a complex situation as far as business ownership. But again, most small businesses, most general contractors and accountants and dentists and doctors and service people and restaurant owners and so forth do not have to report their business because they own more than 50% of it. It's a U.S. business and it has fewer than 100 employees. Fourth tip, there's a couple of convenience items in the FAFSA. So there's a way for you to transfer data from the IRS to the FAFSA. Now, in concept, it's a pretty neat idea where you can go in and say, I'd like to transfer the data from my tax forms. That way you don't have to actually enter the data. The challenge is the tax forms need to be submitted to the IRS and they need to be processed in order for this system to work. And for most people that are on these deadlines that we've talked about earlier, you're not going to be able to have your taxes filed and processed with enough time to actually be able to take advantage of this feature. So for most incoming freshmen, you just want to skip the IRS transfer process. Again, it just has the opportunity to delay things more than you would like. It may be useful, however, once you have a returning sophomore or junior, because oftentimes the deadlines for returning students is substantially later, say April or May, and then you may have time to get your taxes done and then transfer the data. The reality of it is it's not that difficult once you have the taxes to look up the proper numbers and transfer them manually. And it's about 10 or 12 pieces of data typically. Now, there is another convenience item on the FAFSA that is useful. If you are a parent of multiple students, you have the opportunity to transfer the parent data from one FAFSA to the next. So that may be very useful. You have to realize that the FAFSA is based on the student. So let's say you have twins, little Johnny and little Susie. You can fill out the FAFSA for little Johnny, and then you can transfer all the parent data over to little Susie's FAFSA. And it'll save you quite a bit of time as far as names and socials and all kinds of data like that. You're still going to have to adjust things a little bit because you're still going to have to put in Johnny and Susie's data, which obviously will be different. Their names and socials and all that kind of stuff is different. But again, that's a great convenience for families that have multiple kids in college at the same time. Then the last thing I want to talk briefly about is, after all is said and done, you may look back and say, we didn't do the best we could have. And the next thing to realize is this is a 1-year situation. So you're going to fill out the FAFSA for next year, but you're going to have to do it all over again the following year. And you're going to have to do it all over again if you have multiple children. So just be aware that even if you didn't do the best job you think you could have this year, there's always next year for the same students. And there's also, if you have multiple children, there's always time to kind of sharpen the pencil and do better for the next couple of years as you learn more about the process. Again, I occasionally have families come to me where there's not much we can do because most of the year has passed and we can't change their taxes. We can't change their income for last year, but we can change it for next year. So it may make sense to do long-term planning, get what you need to do done now so that you're not late and so forth. And then do longer-term planning, once you have the forms submitted and make sure you're doing the best you can for the next few years and the next children and all that kind of stuff. So those are the quick tips for parents of seniors. Next, we're going to roll into the top 10 financial aid mistakes. Again, this is a document and some ideas that I put together over the years. And this is more applicable to families no matter what grade level you're at, whether you have seniors or freshmen. And it's time to really understand how financial aid works so you can plan accordingly in more of a long-term situation. So here's the top 10 financial aid mistakes. Number 1 is putting assets or savings in the student's name. In the tips I had mentioned, you may want to try and take it out of the student's name, but from a longer range planning perspective, it may make sense to never put it in the student's name to begin with. A lot of families will put assets in a UTMA or a UGMA because it gives them a little bit of tax benefit or they want the student to own it. And from a tax perspective and from an ownership perspective, it may make sense. From a financial aid perspective, it may not. Now, it's important also to realize that all these financial aid planning is all predicated on whether or not you're going to qualify for need-based aid. So I guess before we get too far into this, just remember that a lot of these planning ideas are appropriate if you're going to qualify. But if you're a type 3 family who's not going to qualify for any sort of need-based aid, then you may do your financial aid planning differently. And if you don't understand what that means, again, you can go back to episode 2. In other words, go to tamingthehighcostofcollege.com/2. And that will get you to episode number 2, and where we talk a little bit more about the types of families out there. All right, so number 1, putting assets or savings in the student's name. In general, you want to be very careful when you do it, because often you're going to spend a lot of time trying to undo it later. There are some alternatives where you might say, well, instead of putting assets directly in the student's name, I'm going to put it in mom and dad's name. But we're also going to put it in a 529, or we're also going to put it in a Roth IRA. We're also going to put it in an education savings account. So there's lots of different ways that you can save for college that won't necessarily have as large of impact on need-based aid. Another example I often give is, let's say grandma and grandpa say, we're here to help. If they write a check for $10,000 and they give it to your student and it's in the student's name, you're going to have to report it as an asset. And that asset may have an impact of almost $2,000 on how much aid you're eligible for. Now, if instead Grandma and Grandpa gave that same $10,000 to Mom and Dad, it now would have an impact of a maximum of $560. So it could have no impact at all, depending on where Mom and Dad's assets are before they receive the money. Or it could have an impact, in worst case, of about $560. But the last idea is Grandma and Grandpa keeps the money, and they just save it in their own name, and just say it's available for college and let the student know when they're ready for it, and when it makes sense, they'll provide the money. And that gives a lot of flexibility to the family where they can not report it as an asset, perhaps, and then not take the money until their senior year of college or something, and it never shows up anywhere on the financial aid. Mistake number 2, increasing the parent's income in the base year. If you have a junior right now, your base year is 2014. So the base year starts in the middle of your junior year and goes through the middle of your senior year. And that's a tax year. So if you have a student graduating in 2015, you would have a junior as of to this recording anyway. And right now it's 2014. So 2014 is your base year. So everything you do in 2014 is going to show up in your taxes, and the taxes are going to be used to report your financial aid about a year from now. If you have a high school sophomore, then your base year is going to be 2015. So you have all of 2014 to do the things that you need to get done so that it won't show up in your base year. But you want to avoid, as an example, increasing the parent income in the base year. Well, how do you increase income? Now, what I'm not saying is, well, if you get a raise, turn it down. Any income that you can receive and your only other option is to not get it, you probably want to take the money and run. As an example, a raise or a bonus. But if you're a business owner and you have control of when you receive the income, you might strategically plan which year it's going to land in. I'm not saying give up the income. I'm just saying put it in the year that's appropriate for you. Or avoid things that are going to increase your income, like selling assets at a capital gain, or taking money out of your 401ks or IRAs, where you have to report that as additional income. So that's, again, you want to do the best you can. And of course, the opposite of that would be also, if you could have a way to reduce your income, you might want to consider paying for your health care a different way, signing up for spending accounts or savings, health savings accounts, and those types of things. Renegotiating if you get a company car or not, or if you get a stipend or income instead. Mistake number 3, failing to plan for financial aid. I think a lot of people don't really understand financial aid, and they don't plan for financial aid. So they just kind of let it go, and they just wait to see how it's going to turn out. So again, if you know college is coming, you may want to spend some time figuring out if you're going to qualify for need-based aid, and if so, how much and how it all works out. And you really need to plan, because there's a lot of rules out there, and I've given you some tips and tricks right now, but you always want to avoid any rule that says always or never. As an example, I've often said, you do not want to have assets in the student's name. Well, that's only true if you're going to qualify for need-based aid. If you're not going to qualify for need-based aid, then the rule might be that you want to have assets in the student's name. So again, you need to make an individual plan for yourself. Another big financial aid mistake is starting your planning too late. I just gave some quick tips for seniors, and there might be other things that those seniors could have done had they started in their sophomore or junior year. I think most families need to really buckle down and figure out how need-based aid and merit aid and the various financial pieces of the puzzle are going to work for them, and they need to do it sophomore year, early junior year. so that they know by the time they get to their base year whether or not they're going to qualify for need-based aid, whether or not they should avoid putting assets in the student's name, and not just base it on, well, what their gut feeling is or how it worked out for their brother-in-law, but actually understand it for you specifically. Another problem I see is overuse of 529s. Okay, 529s are an asset, and they are reported on the FAFSA. So while you may get some wonderful tax benefits for 529s, you also have to understand that it may have an impact on the amount of financial aid you receive. And 529 plans are actually, and they are the college savings plan if you're not familiar with them, but they are actually reported for all students. So if I'm a parent, in my example, I've got Zach, Alex, and Isabel. They're currently, 7, 9, and 11. And if I were to start saving for them now, and I saved, thousands of dollars every year for multiple years, I'm going to have to report all of their 529s on the FAFSA for each student. In other words, I'm going to add them together because they are a parent asset. So I get to college in 6 or 7 years, there's $50,000 in each 529. That's a $150,000 asset that I need to report when it comes to financial aid. It's not just what I have in the oldest name, Zach. It is what I have in everybody's name. Another big mistake, which we've covered a little bit in the previous tips, is missing your financial aid deadlines. I've seen families miss out on what I would estimate to be around $20,000 in aid their freshman year because they didn't meet the deadlines that the colleges put out there. And by the time I met them and we got things cleaned up and we got the forms submitted, the college wouldn't budge and they said, "You're too late. The money is gone. We can either defer your acceptance until next year where you might have a chance at aid," which they didn't promise, by the way. They just said, "We'll do it then," or you can pay full price to get started this year. It's up to you, your choice. So unfortunately, by being late, they're now in a really tough spot. Number 7, neglecting your debts. Again, your debts like your credit cards and car loans and other things are not considered for financial aid purposes. So any of that type of debt, consumer debt, you may want to pay off with assets that do count in order to improve your financial aid situation. Another big thing that I see with financial aid mistakes, and this is number 8, is assuming you're not going to qualify for need-based aid. I've seen families earning income as high as $250,000 a year qualify for some need-based aid. And I've seen families earning $75,000 not qualify. The challenge with financial aid is it's very complex in some regards, and it takes into account things like the price of the school you're attending and the number of students you have. So I've seen, again, relatively high incomes in the $250,000 range qualify for need-based aid because they have multiple students and the students are attending relatively expensive colleges. Now, on the flip side of that, I've seen families earning relatively low amounts of money attending a low-cost state school where they didn't qualify for any need-based aid. So you need to understand your situation again. What types of schools are you considering? There's a big difference between living at home and attending the local state college and paying $15,000 a year and going to NYU and paying $60,000 a year. The higher-priced colleges make you eligible for more need-based aid. Of course, there's a big caveat there, and just because you're eligible for more need-based aid doesn't mean you're necessarily going to get it. So you need to understand that part of the process as well. Number 9 is poor communication with schools. So if you've got a senior right now, you have to remember that the financial aid office is your ally. Their goal is to help you figure out how to pay for college. Now, there's some limits to how they can help, but they certainly will help you with the federal financial aid process. Most colleges would be happy for you to take a government loan in order to pay and come to their institution, and they'll help you do that. Now, they may not help you with saving strategies and tax planning and a lot of that other stuff, but they are available for figuring out if you're going to qualify for need-based aid, helping you fill out the FAFSA if you need some help, and also helping in what we would call professional judgment. Sometimes the FAFSA is not a good indicator of how much assets and income you actually have available because it's based on information that's almost a year old. So if you have a change in situation, you have a disability, a divorce, a disaster, change in income, unemployment, all those types of things, you need to work with the financial aid office because they can make adjustments to how you fill out the FAFSA based on their professional judgment. A few years ago, we saw this a lot with Katrina. People that lived in the New Orleans area that had thriving businesses and were doing very well suddenly did not have thriving businesses and their income plummeted. And a lot of the colleges were able to make adjustments and delete some of the income and assets that were on the FAFSA and change the picture substantially so that students would qualify for aid where in the past they wouldn't have. You also need to work with the financial aid office if you've got situations like an uncooperative spouse. In a divorce situation, sometimes mom or dad are not willing to do what needs to be done in order to get the FAFSA filled out or in a separation, so there's a number of different reasons why you want to be in contact with the financial aid office so that they have the ability to help you, but they're not going to help you until you ask in most cases. And they don't know your situation until you tell them. So again, you want to work with the financial aid office where appropriate. And the last idea is, as I mentioned earlier, is number 10 is reporting your retirement plan as an asset. I've seen a lot of families who have a 401k of $400,000, $500,000 inadvertently report their 401k as an asset. And it just completely changes how their financial aid form looks. So again, you need to go back and understand what assets count and what assets do not count. And we covered that quite a bit in the previous segment about 5 tips for seniors. So there you go. That's the 10 financial aid mistakes that I see out there. I mean, obviously there's many, many more, but it gives you some food for thought. Hopefully you're enjoying this information. Again, for most people, I'm out there on iTunes. So if you're interested in subscribing and getting every episode as it comes out, you can go to iTunes or Stitcher. If you're not sure how that stuff works, talk to your students if you need some help on the technology. But it allows you to download these programs directly into a portable device like your phone or your iPad or iPod. Give us ratings and reviews and send us your questions. If you have questions, please email them in or go directly to tamingthehighcostofcollege.com. There's an orange button on the right side where you can click and you can record a message directly to me. And if I get a chance, I will play your question and record an answer to it here on the podcast. And even if I don't put it out there on a podcast, I certainly can get back to you and answer any questions that you might have. So again, go to iTunes and give us a review and pass this on to anybody that you think would benefit from learning more about how to plan for college. I appreciate you listening. That's all for today. We're going to move now to Brad Recommends.
The latest tips, tricks, and tools you can use today. This is Brad Recommends on Taming the High Cost of College.
Today on Brad Recommends, I'm going to recommend a book called The College Solution. It's a book written by Lynn O'Shaughnessy, and it's a pretty good book, kind of the basic overall college dilemma. And there's sections in here that talk about shrinking the cost of college is a big part. There's 15 chapters on how you pay for college. Part 2 is increasing your admission chances. There's chapter 16 through 27 on that. Part 3 is understanding your academic choices. Another 5 or 6 chapters on that. Evaluating academics is another part. The admissions nuts and bolts. And the final section would be borrowing for college. So there's 50 chapters in this book. There's a lot of great information as far as a great way to get a good general knowledge across the board in all the different pieces of college planning. I think she glosses over a few things as far as not going in as deep as she could, which realistically then this book is about 250 pages. And obviously if she put it all in there, it would be a 5 or 6 or 800 page book. So it doesn't make sense from the author's standpoint. But if you're looking for just kind of a great place to start, I would recommend, especially if you're a parent of a sophomore or junior and you're just getting into the process, if you enjoy reading, this would be a great way for you to kind of get your feet wet and start learning the ins and outs of college planning. If, however, you don't enjoy reading, a good alternative, of course, is to listen to this podcast and while you're driving around or whatever. And that's another way to also kind of get your feet wet with the various pieces of the college planning process. If you want more information about the book, you can go to the show notes at Taming the High Cost of College /10, this is the 10th episode. And there'll be a link there that'll take you directly to the Amazon page that has this book. All right. Well, that ends things for today. So I'm going to wrap things up. I appreciate you listening. If you ever have questions or concerns about college, please feel free to give us a contact directly through our website. There's a way that you can send us an email, or if you want to, you can also record a audio by clicking on the Send Us Some Feedback orange button at the website. And that will help allow you to record a comment. And if you have questions, we can use those questions in a future podcast and give you the answers that way. I appreciate you listening, and please send this on to your friends and family. Thank you.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns two companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.